So thank you for coming. This is Noshi, and today I will explain to you how I operate on a daily basis. It's the same thing. Every day I do the same. I go through the process same. Just like you go to the McDonald's, it doesn't matter if you are, unless you are in China, they make you give you different burger. But unless you're in America and you go through from one drive-through to another, or any McDonald's or any Chipotle, or they have the same system. They give you the same. So the market is like that. It's the same every day. It's the same thing. Um, there are few twists and turns, so a few things to learn every day. So I'll explain to you how I go about doing my thing, and maybe you can learn a few things from me, and you can teach to someone else. Okay, yeah. Here is the first slide, which is very important. So please pay attention. This is very important. If you understand this, you will conquer the trading. So this is very important slide. If you understand this slide, you will be able to conquer the trading. So I learned the hard way, and I'm still learning. So the three contributing factors of trading success is you. So you, yourself. Then the next factor is the risk management. And the third is the trading system that fits you. So you means only you are a unique person. So we all know that we are all unique. One such person in the whole world out of 8 billion. So imagine if I'm unique, then my beliefs are unique, my mental states, every moment is unique. Every 15 minutes, maybe I'm going through a different mental state. So 10 minutes uh, before from now, I had a different mental state than what I have now. And then the mental strategies. So my beliefs, so my environmental beliefs, what I think about the environment, my value beliefs, what value I have, my capability beliefs, what I think I'm capable of. So the limiting factors I put in. Yeah, so the comfort zone I am in, or I'm trying to break through. So think about all that. Then my identity beliefs. So uh, where I came from, where I grew up. So I'm a different person than you are, because the country I born, the village I live, the city I live, the people surrounding me, my family, my parents, my brothers and sisters and cousins and my children and my wife, all of them are affecting me. So I'm affected by them, and I'm affecting them. So they gave me the beliefs, and I'm adopting new beliefs. And then I have beliefs about the market, my trading capability beliefs about the market, the way I think the market behaves. So all these things I'm bringing it, whether consciously or unconsciously, in the market, and I'm operating based on the beliefs. So this is very important subject that you work on figuring it out. What are your beliefs about anything? So anything in the world, and then what mental states we adopt. So in any given moment in the market, we on one hand we are being confident, on the other hand we are adopting the mental state of being patient, and so on. And then based on those mental state, then we go on executing these strategies. So the strategies we execute is not the trading strategy. So this is different than um, uh, 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 this is different. What we think, what kind of a sequence we need to go through in our brain. So what kind of sequences we are going through to which is related to that mental state. So if I'm being patient, then I will think about that I have to be patient and wait for this thing to happen. Then what I will do to go through that, to execute that mental state. If I'm being confident, then what kind of a mental strategy I will adopt, which relates to being confident. So if I'm confident and I'm trying to execute a trade, then there has to be certain strategy related to that mental state of being confident. So think about that. So the expert says that this is 60% contributes 60% towards our success. The me. I'm contributing 60% towards my own success, and based on my beliefs, mental state, and mental strategy. Then the 28% of my success comes from the risk management. So this risk management is a big topic. People do PhDs, they're professors, they're Nobel laureate, but you can do some basic risk management, as basic as on a notepad or on a calculator before you execute the trade. So the two questions which we need to ask, there are two basic questions on in a risk management, which are very basic. So this is a big topic. If I learned, and there are very complicated models behind, but the basic is, whenever we are putting the trade, we need to ask how much we are willing to uh, put in this, how much we are willing to put in this trade. So how much you are putting in this trade. So the answer comes from three different variables. Two are constant, and one can be constant also, the third one, but which is variable, and the variable I will explain to you. So the two constant, in the equation is that you need to know your portfolio size. You know your risk profile. So you know your portfolio size and you know your risk profile. Risk profile means how much you are willing to uh, risk in each trade, which will come from you. So you know how much you are willing to risk. Some traders, they are not willing to lose more than 2% in the trade or 1% in the trade. So if you are willing to lose 2% in the trade, and you have a portfolio size of 100,000, which means you're willing to lose only 2,000. So per trade, you're willing to lose 2,000 because that is your risk profile. You know your portfolio size of 100,000. So 100,000, 2%, you're willing to lose, so 2%. So 2,000. So this 2% is coming from you. Another trader may be saying, no, I'm only willing to lose 1%, which is 1,000. So this is a constant. You're willing to lose how much? Your portfolio size. Portfolio size is changing, let's say, from week to week. The third question is where you will be stopped out. So that's the question, where you will be, how much you will, where you will be stopped out. So the question where you will stopped out comes from your trading system, the way you are analyzing your entries and exits. So your where comes from your entries and exits. So if you assign some weight to your trading success, the 60% is coming from you, meaning understanding yourself. This is a big topic. 28% is coming from your risk management, and only 12% coming from your trading system, the charts, etc. You're figuring it out and you're entering it. So think about it. If some same trade given to two different people, it's the same trade, it's the same entry, and let's say same exit, or same entry, but different traders will execute uh, differently. They will exit differently. They will um, risk differently. Today, I received an email. So this person, he's taking a trial. So he's taking a trial. Think about this person. So he's taking a trial. And he signed up maybe on Friday or something. We send the trade for Domino Pizza, DPZ. And so Domino is moving up and down, and is from the moment we entered, it went up. I mean, I didn't see any drawdown in the trade. So this person sent me email to my team saying, "Hey, where is the stop loss? I'm losing $180 in it." So think about this person. He's operating from the fear. He, I don't know, $180. Did he buy 100 contracts? Is he buying one contract? And how is he losing $180? But he was panicking. Hey, where is the stop loss? And I'm already down $180. So what I do in this situation, told him, I told my team, hey team, send him the message to close the trade at break even. The trade is at, doesn't matter. It is, I know it's in profit. So I sent him the message. close the trade at break even. And then I told that opt him out because I know that he doesn't fit. He doesn't fit because he is panicking. $180. Hey, where's the stop loss? 100. I'm already down $180. So he's gone because I know I have no matter what, he just doesn't fit in this. So the same trade given to two different people, they will come out with the different results. And why? Because they have a different risk profile and they are operating on a different level. So beliefs, mental state, mental strategy, they're executing. So this person was operating, first of all, he operated maybe, I think he operated out of greed. So he, let's say I send a trade to buy at 880 or something like that, the January 390 calls, and he may have entered at 950 or 10, and then he may have bought 10 contracts. I don't know. And then it pulled back from, so my entry is at 880 and his is maybe 950. I have no idea. And then it goes to 929, 910, and he has, let's say he bought 10 contracts. So 10 contracts, $180. So it is, and maybe $180 is too much for him. Whereas for someone else, $180 is part of, it's just a little money. So think about it, the trading system that fit you. So my trading system doesn't fit him, and it's no use for me to please him. So please understand that 60% comes from you, 28% come from risk management, and 12% come from the entries and exits. So the most important factor is you. So please uh, study yourself. So the beliefs, so this belief is a big topic. I'm constantly learning. I have a different presentation content I created, like 2-3 hours and like 5 sessions. So 2-3 hours of 5 sessions I have created and I will teach. So just to give you an idea, your trading beliefs. So when we are trading, we are believing something. So we see a candle and we say, this candle is telling me that is going up. This market is going up. If we are using a stochastic, saying, I'm sure stochastic is giving me sold out reading. So based on, I'm sure I'm sold out, so maybe I'm going long based on just a stochastic. I'm sure this moving average will hold. So we bring another belief about a certain moving average that this will hold. Let's say 20-day moving average. I think the market will tank soon. So if you think the market will tank soon, and I do receive emails from now and then, hey, the market is down 200 points, so should we exit? So they go and close all the position. I'm sure market is telling me something, so something they're trying to make from the market, and the market doesn't know what you're trying to make out from the market. I'm more successful in downtrending market, so this is another limiting belief. We bring only trade to the downside. So sometimes downside works, sometimes downside doesn't work. I'm sure T-bills are going to have a major correction shortly. So we bring our opinion in the market, whereas market doesn't know you're bringing your opinion, and then we start trading based on these opinions and beliefs. So market is very big, as we know. So we have to be cautious in what beliefs we are bringing in the market. So if we dissect the market, or if we study the market is bullish, bearish. People say bull market, people say bear market, and then they say sideways market. So this is a big definition for me: bull, bear, and in sideways market is big. Somebody will say market is in bull since 2022. Somebody will say market just started its new bull now. So for me, as a swing trader, so I divided the market into uptrending market, downtrending market, and sideways market. So whether the market is in uptrending, so like right now the market is in uptrending fashion, and whether the market is in downtrending, so going down, and then the sideways, the choppy market. So uptrending, downtrending, and sideways market. This is my three main definition of the market. So based on, so what I did, I analyze the daily movement in the market. So daily, what I do is indices, like 4 indices: Nasdaq 100, Russell 2000, Dow Jones, and S&P 500. So I analyze these four indices. Then what else I do, I analyze the bottom-up approach also. So the bottom approach is meaning those stocks in these, not the Russell 2000, but the S&P 500, Nasdaq 100, and the Dow Jones 30. Analyze bottom up. So somewhere on a daily basis, I feed the data in my, I used to do it manually, but now I programmed it and I feed the data every night and I come up with my own decision whether the market is uptrending, downtrending, and sideways. Then, and what time interval. So whether it's a weekly or a bi-weekly or on a monthly basis. So I call it major. If it's on a month-to-month basis, it's a major. Intermediate, I call it after 2 weeks, and a minor downtrend or uptrend, I call it during the 1 week. So that's my definition of analyzing the market. And then if you dissect further, then when the market is, if the market can be uptrending, but market could be quiet and volatile. So right now, in the market, according to my definition, currently the market is uptrending and in a quiet fashion. So when the market is uptrending and it's quiet, meaning it's not volatile, it's not moving up and down. And usually the market which is uptrending, the history says the market is usually quiet. The uptrending market is not a volatile market. So when the market is uptrending and it's in a quiet, so market is uptrending and the history tells us that it's in a quiet. So the quiet you can analyze based on the volatility. So when the market is uptrending and the market is quiet, generally the stocks are uptrending day by day. Generally the market, the stocks are trending upward day by day. By the time you realize, if you are out, um, if you're out of the market, by the time you realize that the market is moving and everything is looking good, it's time to get in the market. Like people send email, I'm thinking of going long in the market. That's the time where market has already traveled far, and is about to either go on a sideways motion or about to turn it down. So think about that. So uptrending market is usually quiet, not volatile. Now the downtrending market, which was last month or so, the downtrending market can be quiet or volatile, but the history says that the downtrending market is volatile market and it doesn't last long. So compared to the uptrending market. So downtrending market is volatile. If we know that on average, the downtrending market is volatile, then and it's not quiet, so then what happened? We need to adopt the strategy of volatile market, meaning we when we're going short, we need to take profits. There will be some stocks or some market which just continuously going down, and then you say, oh no, why did I exited? I exited too early. But in general, when you take the average, the market is volatile, meaning it will go down one day and then the next day it's going up. So your strategy will be different for trading the downtrending volatile market compared to uptrending quiet market. So the strategy is different for trading uptrending quiet market compared to downtrending volatile market. Now, the third market is the sideways market. So sideways market usually stays like 70% of the time the market is in a sideways motion. So sideways market could be quiet and volatile. So it so we need to realize that the market is in a sideways and is trading in a range. So again, if the market is trading in a range, then we adopt the strategy which is related to sideways. Usually, unless you have a strategy for sideways, it's better to wait it out in the sideways market. You're not going anywhere. So in a sideways market, you're not going anywhere. So avoid the sideways market. When the market is downtrending, you understand the volatile market is volatile and it's short-lived. It's going up one day and going down one day. So keeping this history in mind. And the third is the uptrending market, which is most of the time it is quiet. It's not volatile. So if we know this in our background that this is the kind of market we are dealing with, then we go about, then we ask the next question whether we are suitable to trade this kind of market. Maybe you are suitable yourself, your personality type, saying that you can only trade uptrending quiet market. In uptrending quiet market, there if you are trading uptrending quiet market, the margin, you have a bigger margin of error. Whereas in a downtrending volatile market, if you don't get in at the right time and then don't exit, you have a bigger margin. You have a chance of losing money in a downtrending volatile market compared to uptrending quiet market. So the market is uptrending quiet, you have a higher chance of growing your portfolio right now compared to last month. So maybe you're not fit. Maybe I'm not fit for downtrending volatile market. Maybe I'm just fit for uptrending quiet market or uptrending volatile market. So ask yourself what kind of market you like to trade. So once you know what kind of market you like to trade, how you know? Because of your performance, past performance, the way the market behaves. So only you know. So if you know yourself, your beliefs, your mental state, your market, your mental strategies, and what else is going on. So if you uh, create the if you think about the Venn diagram, so this is the intersection of you and market. So this market, maybe it's uptrending quiet market, fits. So you will ignore all the other kinds of market type and you will stay maybe on the sideway, you will reduce your exposure, or maybe you will be in cash, maybe you will park your money in the CDs or bond or something you will do, because that market doesn't fit you. Only you will trade the market which fits you, which is, let's say, uptrending quiet market. So uptrending quiet market is the market which fits you and you will trade. So think about it. There is a money to be made in a certain kind of market. So that fits you. Now, once we understand what kind of market fits me and who I am, then the next step is to figure it out how I will trade. So this is the topic. I will explain to you the 12 different systems and see if you can give you some aha moment and you put 2 plus 2 together. So I will give you some combination. I will explain to you. It's not just one thing. You say, okay, I master this, and then I go about and making money. You have to put many variables, many system, many strategies together at that time. What is happening? So trading system. So trading systems could be your moving average system, your gap trading systems, the trend trading system, support and resistance trading system. So what kind of a system you, or the chart, you use chart pattern like head and shoulder and double top, double bottom, etc. Do you use candlesticks? Do you use just regular bars? So what do you use? So, and then also don't forget that the kind of a system you're using, does it fit for that market? So maybe it doesn't fit that market you're trying to trade. So you have one system for let's say for going long, and another system. So if you use the same technique um, for trading the long market, and then suddenly the market changed to the downtrend and you stick with your strategy or your technique going short, you will lose money because you're not realizing that the techniques or the strategies or the trading system, whatever you're using, doesn't fit that market. So the market has changed, but you did not change, uh, like you did not pull the rabbit or a different rabbit out of the hat. You did not. So now you will start losing money. So the trading system should fit for that kind of market. So it's you, then the market, and then you should have at least two kinds of two strategies or two trading system, etc., for trading the market, long or short. So so there are how many? 16 here. So 16 boxes I just to show you. as example. So there are so many trading systems, so many chart patterns, so many trading strategies. So we cannot master in the beginning. In the beginning, you start with one and you master it. Then you go for second, and then third, then fourth. I don't know about you, but it takes, they say, the experts say, it takes 10,000 hours of mastering something, 10,000 hours. So if we put only 20 hours or 50 hours and think that we master it, we are fooling ourselves. Unless, I don't know, maybe a genius, you creative person in genius, but for me, 10,000 hours, that's what say, and that's what happens. So now, in order for us, so there's so many trading systems, there's so many strategies. So how you decide which one? So start creating a put some kind of criteria. So these are the criteria I was told in the beginning by my mentor, to focus on those strategies or systems which are consistent. So consistent, so then once you see what is happening, it it chances are that it will, and you think what will happen, the chances are that it will happen. So it's consistent. It's not one day there is one result, another day is another result. Another thing is frequency. So the turnover in your trading. So if you are a swing trader, the turnover is, let's say, 1 to 7 days. And if you master something which, um, let's say you master head and shoulder, and you're looking for the pattern for head and shoulder, and head and shoulder is not appearing, where you will find that head and shoulder. There are 9,000 stocks. I don't know, maybe 10,000 now, but let's say 9,000 stocks. So if there are 9,000 stocks and you master trading head and shoulder, so are you going to scroll down each 9,000 stocks to come up, find the head and shoulder pattern? So it's not going to work. And first of all, you cannot laser focus on the 9,000 stocks. So that's another slide I will explain to you. So frequency, so whatever you master that it's coming frequently. So just think about it. Frequently is appearing every day. If it doesn't appear, if you cannot find what you are looking for, it means it's not there. So you have to be patient. It's not there. So that's what it is. And then once it's there, so it's there and we read it correctly, and then it's reliable. So you know that most of the, so you have tested it before, that once you find that pattern or the techniques you're adopting or the system you're looking for and is giving you the trade, is reliable. So all the ducks are in the row. Plus the reward. So the reward has to be there. If the risk is too high and the reward is not there, then just ignore uh, uh, that trade. So maybe you have a system where the reward, it gives you the trade, but the reward is so tiny compared to the loss risk you're taking. So it's not worth it. So based on some criteria, you come up with your trading system. So based on some criteria, come up with your trading system for the long side and for the short side. And if you want to trade the sideway, then you need to have a third system for sideway market. So knowing all that, me, myself, the market type, and then I know I need to come up with some trading system. There has to be some cross section. So market and the trading system. So whatever kind of market, if the market is uptrending and quiet, then I need to have a trading system for that kind of market. If the market is downtrending and volatile, I need to have a trading system for that kind of a market, because the system which is meant for downtrending volatile will not work for uptrending quiet market. So there is an intersection there. Now, again, I have to ask myself, what is my trading horizon? I'm, I'm am I a scalper, or am I a day trader, or am I a swing trader, position trader, long-term trader? What kind of trading I'm doing? Because the kind of trading I'm doing, um, so, so the trading system I need to adopt based on my trading horizon. If I am looking for a volatile system, maybe I'm looking for it will fit for day trading. It doesn't fit for long term. If I have a trading system which gives signals, or I read on let's say on a weekly close basis. So on a weekly close basis, I read something and I say, okay, this I better wait for the Friday to come, and when the Friday comes, then I will get my signal. So that signal is valid, and you can by Friday close, maybe you get the signal and then you put your order on during the weekend to trade, buy this when the 1,000 shares of this at market open. So that is your long-term system. And then you just find 5, 6 candidates based on this long-term trading system. On Friday, you execute, put your order on a weekend, and it becomes a market. It just, your broker executes your order Monday morning when the market opens. So that's why you see there's a surge in either the buying or selling. And so that could be your system, but this system is not suitable for me trading as a swing trader. So think about that. This long-term system on a weekly basis or a month-to-month, 30-day close higher, then I will enter. So it's not fitting my style of swing trading. So I cannot use that system for swing trading. So think about that. Your trading horizon, and your trading horizon is coming from your capability, beliefs that you are capable of trading short-term moves. So if you believe that you cannot trade short-term moves, so if you believe that you cannot, then you shouldn't be trading the short-term, and you shouldn't be trading that system which doesn't fit you. So think about this. So what people do, they mix different things. Trading system which is meant for long term, they're using into swing trading. The account they have for long term, they are using it for swing trading. The account they have for stock, they are mixing it with options. So they are trading options in it. They are trading stocks in it. It allows they're trading futures in it. So it's kind of hodgepodge, and then they bring their retirement account into it. So they do all that. They go on a margin, so it becomes a mess. They don't even know how much they are trading, how much is where, and whether they are capable of trading, whether the market fits that kind of a trading. So it's a mess. So think about that. So let's focus on swing trading. So swing trading is a speculative trading strategy. You for swing trading, you cannot trade a swing trade. I don't know how people can trade a swing on a stock like AT&T. So AT&T, if the stock moves 20 cents, 30 cents, it's not for me at least. So trade active markets and trade liquid markets. So liquid market, maybe you have a certain criteria. I will trade a liquid market 1 million minimum daily basis shares, maybe more, 5 million, and trade those markets which are in the news. So there's always something going on. So you are tightening your horizon, your universe, your trading universe. You're tightening your trading universe because you want to laser focus in that market related to your likeness. So it's speculative trading strategy, trading the active market, trading the liquid market, and trading that market which is in the news. So you're using the trading system which also fits these criteria, and then you are filtering the symbols. So I'll explain to you filtering the symbols. So like Apple, Baba, Baidu, Shopify, etc. These kind of the stocks. So all that, when you know that you are doing, you are preparing yourself for this kind of trading, then you will focus on developing a system which is called a low risk trade idea system. So low risk doesn't mean a low risk 5 cents. It means the low risk, low risk is defined in this paragraph. So a low risk trade idea is an idea with a positive expectancy that is traded at an exposure level. So this is important, exposure level, meaning how much you are willing to lose in that market, how much you are investing in that market, that allows you to survive the worst possible contingency. The worst possible contingency in trading, the stock you went long, it goes bankrupt. So it goes to zero. So that is the worst. If you trading option, suddenly something happened and the stock goes 100% loss, the option goes 100% loss. So that is your worst contingency. Maybe the stock gaps down 10%. So that is your worst. Then you know that 10% gap down will wipe out your, at least your option. And you're down, if you're trading a stock, then you're down 10%, or it could be 20%. Some accounting fraud happens and you see 20% drop, 25% drop. So even if that happens in the short run, you still achieve the long-term success. So the key is the proper exposure levels. So if you are properly managing your trade based on the risk level, based on your exits, um, even if the one or two stocks in your portfolio, or four or five, whatever is it, going the other way, you're still coming ahead over the long run. So that is the definition of low risk trade idea. So based on this, then we will create our trading system. So, and write it down. So develop the low risk trading game plan. So write it down on paper, or you execute it so much that you're not even looking at the paper anymore because it's all in your head. And then every day executing this trading game plan. So every day you wake up, you do the same thing. So if you put a camera and remotely watch me, you will predict exactly what I do every day. If you put the camera, you will know, oh, he woke up now. Let's see, he goes to shower. Now he's turning on the coffee pot. Okay, here comes the coffee. Then I turn on the TV. I listen to the news. I turn on all my computers, monitor everything, check, talk to my team, and then I start reading the pre-market news, and then I get ready to trade. So every day is the same thing. So once before the market opens, analyze all your open position, analyze the market, cash market, and where, based on the futures market, where the cash market will open, what is happening in the futures market, which is it, is all the stocks are moving like in general, or is it just the big Momo stocks are green and other market is red? So Apple, Baba, Baidu, these are green, Nvidia is in the news, AMD, and all others are red. So what will happen? What do you expect? Whether those big greens are the leading indicators or they will turn red. So you have to analyze all that, whether you have a position in one of those stocks, and whether they are gapping up or gapping down. So all that goes into play, and you, when the market open, you're watching everything in a detailed manner. So in a detailed manner, and as the market moves further, as the time goes by, you step back and monitor, not all everything you cannot monitor in a detailed manner. You sit back and start monitoring a few symbols, few market in a detailed manner, and others in the overview manner. So that's different monitoring system: overview and a detail. So trading rules develop. So you have to define your trading rules. You have to define your checklist. So checklist could be checking the support and resistance, checking the earnings date, checking any news is coming, checking the time, as simple as checking the clock before executing the trade. If it's 6:59 a.m. Pacific and I see the trade, I rather wait for 1-2 minutes to pass, let the 7 o'clock news come, and then I execute the trade instead of executing the trade right at 6:59 a.m. And then, so do that, and then at 7 a.m., what the hell happened now? So it can happen like that. So perfectly playing the trading game. So keeping everything in check. So check the support resistance, check all the news. Is there any news? Is there any pending news coming? What is the time right now? What else is going on? So once we know this, then we keep on capitalizing on the low risk trade idea. It's the same thing every day, same, turn on the computer and see what is there. So developing the edge in the market. So this topic is very big, developing the edge. Edge could be as simple as, so if we don't have an edge, um, it's hard to make, um, you can make money, but not, like extraordinary. And developing an edge could be as simple as going to bed early and waking up without the alarm clock. So if you're setting, I don't set my alarm clock. So I stopped setting the alarm clock long time ago. So no alarm clock wakes me up. I wake up myself. So when I sleep early. I know I need 7, 8 hours sleep. My windows are open. I can hear, so natural. Wake up early. So this is a little edge you develop compared to the trader who comes in the market rubbing his eyes, not ready, now don't know what happened at 5:30, don't know what is going on, and he turns on his computer or goes on his phone and try to execute the trade. So think about that. Developing an edge. So this is so write down is create a document of edge, my edge, and then start writing down. Maybe you are good in analytical skills. Maybe you are good in putting a system together. Maybe you are a process oriented. Maybe you have a technology background. Maybe you have a business background. Maybe you have a big picture, you're a big picture person. Maybe you are a detail oriented. So maybe you are both. Maybe you are a creator. Maybe you are a fixer. Maybe you can solve the problem. Maybe you are intuitive. Maybe you are both. So maybe you have a written rules and checklist. So think about that. What do you bring in the market? Then another important is another important skill is to adopt the process of stalking the trade. So stalking the trade, reminding yourself. So your beliefs that when I see the trade, I just don't jump on it. I will put that into stalking mode, and I will stalk the trade. So I was preparing. One time I was teaching this, and so stalking. I said, okay, so this topic is big. Another, one day. So my daughter came and she said, "Well, Daddy, what are you going to teach today?" I said, "I'm going to teach how to stalk the trade." And then she was surprised. She said, "Really? You're teaching how to stalk?" So I had to explain to her in little more that Daddy is going to teach this, stalking the trade, daughter, not what you're thinking. So stalking the trade is meaning you need to remind yourself to go into a lower time frame, and lower time frame as low as possible. So I'll explain to you some time frame. So for stock trading, maybe as low as 5 minute chart. So 5 minute chart will tell you that it's time to enter or not to enter, and maybe you need to wait. And the reason the stalking is so important is to control risk. So there's a big, there's a you can understand. And instead of entering, you find a trade which you can enter at 100, and your target is 110, and your stop loss is 95. So it doesn't matter if you enter at 100 or you enter at 102 or you enter at 98 or 96. Your stop loss should be technical based. If you're a swing trader, your stop loss is technical, and it should stay there at 95. So it's not changing, because that's the, let's say that's very strong support. 96 is a strong, very strong support, and you say, okay, 96 is very strong support, and if it violates 95, I will exit. So it doesn't matter if you are entering at 100 and the stop is, the strong support is 96, it's there. Unless it creates a new support at 97, 98, then you will raise your stop. So so think about this in a mathematical manner. If you're entering at 100 and your target is 110, so you have a 10 point, and 95 is your exit. So 5 point is your loss. So based on this, you can plug in your numbers into your risk management and say, okay, how many, what I will lose, how much I will lose if I exit, if I enter at 100 and exit at 95, how much I will lose. You will lose 5 points per unit, per share, 5 points. So, and how much I will gain? 10 points. So if you know this formula, if you reduce your entry from 100 to 98, you will be able to buy more shares or more contract, because your stop loss per unit goes down to 3 units. So if you can raise your number of shares you can buy by stocking the trade, when you exit from same target at 110, your profit will be higher. It's 100%, it's double. So if you plug in your number, your profit will be double if you can reduce your entry as closer to the exit. So that's what it is. And then when the trade is moving, so when the trade is moving, um, it's not moving in a. Sometimes the trade just moves and go to the moon fast in one day. So today, like Shopify or Domino Pizza, but they go on the step. So every day, if the stock is, or every other day, the stock is doing something which is convincing you that this is the right trade. So what is your plan in adding to that position, more to the position? So it's like it's called scaffolding in construction. So the support they build. So think about that. The stock is exactly doing like that. If you are climbing a mountain and they put the stairs, so let's say they put the stairs, they don't put the stairs 100 stairs or 200 stairs unless it's like 100-year-old. They used to do that is straight stairs, like my grandfather's house, triple story, you go straight up the stairs. He didn't put any landing, no stop in the middle, just go 100 stairs up, and then he put the railing. So the way the stairs are made, you have a landing. So that's the stock does. It goes into some landing space, and then it consolidates, and then it takes off and go to another 5 6 steps. So what are you going to do when you first adopt, when you see that scenario? So are you going to add? Because if you bought 500 shares and the stock is still going on, you shouldn't have 500 shares. You should have 700 shares, then you should have 800 shares, then you have 1,000 shares, but your stop is getting raised. So what are you doing to capitalize that one trade in your portfolio? You have 20 open position, but one is a big green. So how you scale in? And then once you scale in, if you scale in, you tilt your portfolio to one side. So you have more exposure in one trade, and you have a lot of fat green profits. Then you have to start thinking that, okay, I have one trade which is really fat and is a lot of green there, and if it tilts the other side, what will happen to my portfolio? So so on the way, when once you maybe you enter 2 3 4 units, and then you start to scale out. When it will start to accelerate, you have to scale out, because that that trade can also cause you to lose a lot, because you have sudden drop, maybe a gap down, that can happen. And it's a lot of green in one or two trade. Others are small loss, or small gains. So think about that. So it's stalking the trade. Once you adopt the process and learn how to stalk the trade, you will be very precise with your entries and exits, and then you will start executing your trade ideas flawlessly. And then during when the market opens, you monitor those trades in a detailed manner, and then um, step back and start to monitor. You have to have a system where you go in a detailed manner in the morning time, and then you step back and go in the overview mode, and then you filter the symbols which you are monitoring in a detailed manner, because either the exits are coming closer, or you're scaling out, or you want to scale in, or you want to you need to take some action. So when you have to take some action, you have to monitor in a detailed manner. And the way I monitor in a detailed manner, I know the chart is not going to tell me if my target is between 74.50 and 75, let's say for Shopify. Is useless for me to watch what the candle will tell me. I have already made up my mind that I will exit from Shopify. It's between 74.40 to 74.80. So it's useless for me to see the candles, what the candle will. By the time I will read the candle, it's too late. The candle is made up of open, high, low, close. So that's what the candle is doing. Open, high, low, close. It's plotting these four values on the chart: open, high, low, close. So I don't need to watch that candle when the trade is approaching my target. I already know my target. So what I'm doing on a trade, so I have TradeStation. So on a TradeStation, I monitor 18 symbols at one time on one workspace. So on one monitor, 18 symbols blinking, those 18 important. And then on another workspace, I have another 18 and another one on 18. So like, let's say 54 symbols. So if Shopify is blinking on my screen and is saying bid 74.40, ask 74.42, it's blinking 74.40, 74.42, 74.38, 74.40. So it's blinking, 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 and then I can feel it that okay, it is stuck now, and that's it. So I'm getting ready to exit, and I look at, so my on one screen is my option chain. So I'm looking at the option chain, and I can see the bid and the ask, and this is the difference. So I can shave some spread towards my side, maybe 10, 20 cents, and my order is ready to execute, close the trade, and I execute my message. I give you the heads up to my member that execute or close the trade between this range and narrow range, and that email goes out. And when it's time to exit, I also send another email to close, and I'm pushing my button to close the trade. So I don't need to watch what the chart is going to do. If you already know your exit points to the very precise, so exit protocol has already triggered, and now I'm ready to close the trade. And exit protocol could be anything. So there you can list down all your exit protocol, what will make you close the trade. There could be 50 reasons that will tell you that you need to close, or it's as simple as that my profit objective is hit, the target is hitting, and I will close the trade. So you close the trade, and on the same time you're aware of the market conditions. So suddenly the market starts to 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 pull back. So if suddenly the market starts to pull back, and Shopify is trading at 74.40, and I'm trying to see, okay, can it go to 74.80? If it goes to 74.80, my option will move what, 10 cents? But what are my chances of making 10 cents extra and giving back my profit? So the more I stay in the trade closer to my target, the more chances I have that I will end up losing. So the closer the trade goes towards near my target, more chances I have that I will give back. The risk to reward is less, because the reward is the next 10 cents. Think about it. The reward is also at any given, when the trade starts, your reward is something else. When the trade is moving towards your target, and as it's getting closer to the target, your reward, the extra reward, is little left. It's little. So for that extra reward left, how much you are willing to give. If the extra reward is big, so for instance, Domino Pizza. So I have a different strategy for Domino. So for Domino, exited 50% of the, because I see there's a bigger reward there. So I have to close only half of the position, because it's like 700 per contract profit in 2-3 hours. So it's so 50% is like not 50, I think 70% or something. So it's almost my cost is covered. So I holding the 50% of a Domino for the next higher move towards $400 or something like that. So different trade, different exits. In one trade, you are very like you are you're saying, okay, I can't wait for this stock, this trade to close. I like, for instance, today I missed it, Roku, etc. So I said, damn. But Shopify, I got the Shopify, but there was a 75, 74, 50 to 75 was the target. So I had to be very very agile in monitoring the trade in a detailed manner, because I can't let go. This, if I let go, then I may see it falling to 72 or something. But and on the other hand, the Domino, so Domino I can watch on an overview, because I, I studied the chart and I say, okay, Domino is going to 400. And the way the Domino came early morning is not just because I woke up and I say, hey, Domino is going, let's trade. No, the Domino was giving signals for a few days. So I had it on my watch list. The Domino is doing something, and because it's a big stock, so I said it's a big price, I really need to make sure to enter. So that Domino was on my watch list. So be aware of the market condition. Know which trade, which symbol you need to monitor in a detailed manner, and which one goes in the overview manner, and how you will monitor. Because monitoring the stock in a detailed manner when it's about entry and exit, especially in option, especially in option, if you, by the time you look, take help from the chart, um, is over. So make up your mind and execute your trade idea flawlessly. So for option, you make up your mind, if and know your numbers. So knowing your numbers, like memorize your numbers. So it's very important that you memorize your numbers. So if I'm driving, let's say I'm driving, I have to go some meeting, and so I memorize my numbers. So I know, okay, I have these positions and these are the numbers. So do you think when I'm driving and I'm looking, I have to drive, and I'm not looking at the chart. I'm just looking at the numbers. So I'm looking at the numbers and I'm seeing it. For instance, I was long on save the other day, last week. So I reached my destination. I had a meeting and I parked my car at Starbucks, and I was watching Domino and I see 1250. So I look at 1250 and I said, oh, this is the trade I need to close. I need to take my profit. So I closed my trade and I told my team that, hey, we need to send this. The target is 1250. It's hit, and I was not even sure that it will hit the same day. So it hit, we close the trade. So know your numbers, and you don't need to, if the number is blinking right in front of you, you don't need to look at the chart. That's what I'm trying to say. So know your number. When the number is crossed, then you say, okay, the number is across, I see it moving above. Now what is going on? So do like that. Beauty of both worlds. So swing trading is a combination of two concepts. So it's investing and quicker pace of trading, meaning that even you are a swing trader, you act, or so you're holding it for 1 to 7 days. Even you're a swing trader, uh, you're acting like a day trader and stalking the trade as if you will be exiting the same day. So you're exiting the same day. So the day trader exit the same day. So you're exiting the same day, assume like that. So you will start the process of entering and exiting. So objective for the swing trading will be to maximize profit in short period of time and minimize the downside risk. Now, most of the swing trades comes even before the crowd notices. So your system should be that you are noticing the trade before the trade. You know that if this thing happen, this will happen, and this is where the other traders will come in. So do you have such system that you can notice before the crowd notice? Maybe you have a system of putting the stocks which are building up. On Monday, on one hand, you're trading the stock, you have open position, and on the other side, you're building your watch list. So think about that. You're building your watch list on one hand. So if you build your watch list and you have a system of monitoring that watch list, these trade will come to you. And home run, don't look for the home run. Home run will take care of there will be a home run, but home run will take care of the field trades. Is the singles, 40%, 50% gains. So now the stock trading. So if you're looking for 3 to 7% in stock trading, if you translate it, it comes to 40 to 100% gains in option trading. But option trading also have a double-edged sword. It can go the other way. So executing the swing trade. So anticipate the next move to get ahead. So anticipate what the domino is going to do. Anticipate what the Shopify is going to do. Understand the price reaction. So the only if you just watch the price. So are you able to watch the price? Only the price. Bid and ask, bid and ask. You're not watching, like level 2 or market depth and how many shares. You're just looking at the blink of that trade, how it is blinking in front of you, just a bid and ask, how it's what is happening. So are you able to do that? Do you have the capacity or skill to analyze the volume, both absolute and relative volume? So what is the absolute? It trades 1 million, is trading at 2 million, so that's absolute volume. Maybe it's trading at 1.5 million, but what is the relative volume? So do you have a relative volume analysis that at any given moment, at any given time segment, you know that this is trading at a high volume? Like today, the Shopify and Roku, etc., they were trading at a high volume. And do you have a system of buying, where the buying and selling is coming from? Do you have a system of understanding the support and resistance level clearly? Because this is the key, support and resistance. So if you understand support and resistance, your trading becomes easier. So if you understand support and resistance, your trading becomes easier. Through support and resistance, you get your entries and exit, you reduce um, your risk, you increase your profit potential. At resistance, so resistance means if you understand the resistance, you would be exiting before the resistance hit, or you would be adding more to the position when the resistance is broken. So understand the support and resistance. Understand all the major turning points. So go on a lower time frame and see where the twists and turns happen. So identify that, identify all the lines, horizontal lines, vertical lines, all kinds of, divide into time segment, divide into horizontal support and resistance, understand where is the major turning point and which are the minor turning points. So that will give you the ideas for your targets. So for swing trading, there's, in my opinion, there's no need for perfect indicator, because when all the perfect indicators, when they lined up, they're too late. So perfect, if you're looking for perfect indicator, if this is lined up, if this moving average goes above this moving average, and RSI will be like this, and MACD will be like this, and the volume has to be this. So all that, I think that trade is already gone. So trade the system fitting your trading style. So you know which trade system you need. You're different, I'm different. You need to master the proven pattern. So which one you rely on and how you execute your trade. Do you have expertise and judgment and skill, and do you believe in it? Are you flexible? So if you're rigid and you're not flexible, then you have a problem. So if your target, if the target is 74.80 and the stock uh, hits 74.40 and it doesn't want to go above 74.50, so are you flexible? So to exit, and the market is start to drift lower, and your target is 40%. You set your target of 40% gains in option, and it's sitting at 35%, 36%, and 20 minutes gone by. Are you rigid? You don't change. You just don't exit. You want 40%. It's not there. And do you have a system of understanding what the broader market is doing and index is doing? So all that, when you put together, then you stack odds of success in your favor. So that's the swing trading. In our system, in my swing trading, all the trades are, people say, hey, do you send something like overnight? So no, I don't know. How can people send, unless they are trading long term? Like, they don't care if they execute the order, uh, they just execute the order. They don't care if they buy at 100 and it goes to 95, because their long-term system is saying it's long. So I am not like that. Even if a long-term, I will look in the market and buy. So all trades are real. We send the trade via email and Telegram, the specific buy price, 3 sell targets. I analyze not only the technical, but I do the fundamental, and I do write on the base of the fundamentals, and I post on my blog on tradegenie.com. I teach like this. I have developed a lot of quizzes, about 100 quizzes so far I have developed, and I send out during weekend. So if you are willing to improve your trading knowledge, read that article which I write, and then so it's in a detailed manner. You will get some, and then take that quiz. That quiz is 20 multiple choice questions, and sometimes I put in 10 true and false. So take those quizzes, learn. I've so far 100, and there will be more coming. So join the Facebook page, join the YouTube channel. So all that is about swing trading. So I skip that. You know how to contact me. So now I'll talk to you about the trading strategies. So we talked about you. So you're different. We know your beliefs, your mental states, and your mental strategy. Sometimes the mental state is cuckoo mental state, like you're going crazy. Something is happening in your life. Your wife ran away with your children. So if your wife ran away with your children, think about it. And are you capable of trading the market when your wife ran away with your children, or something happened with your family member? So the mental state suddenly changed with just one little news. You came home and you don't find your children, and then you say, okay, I don't find my children, so maybe, and I don't have my wife here too. So what happened? Well, okay, she will come back, and then she never returns. So do you think you will be able to trade properly tomorrow morning? So think about that. So you are different. What is going on in your life is different. Your mental states, and then the mental strategy. The kind of market you're trading, maybe you're not suitable for that market. The system you have, maybe the system you have is not suitable for that market. Then your trading horizon. So think about that. Are you a swing trader or a long-term trader? So if you're a long trader, you don't care about the entry. You just rather buy. You decided you buy at 100 or you buy at 102 because you think it's going to 150. So 2 point is nothing. It's like if we decide to buy a house. Okay, I buy a house for 600 or 620. It doesn't matter because I'm going to live, and the house in 30 years will go to $1 million. So who cares about that 20,000? So think about that. So now you know everything. So now so the same symbol. So you're trading Apple. So if you're trading Apple, um, so it's same giving you the same signal. Let's say long. So are you going to buy shares? Are you going to buy options? Are you going to buy short-term options? Are you going to buy long-term options? Are you going to trade a vertical spread? Are you going to sell an puts? So you collect your premium. You don't mind if it gets put to you. So what are you doing? So you see the same symbol going up on the chart is blinking, is going up, and then you ask 10 people, they will tell you how they can make the same symbol, how they can capitalize on that symbol. So the expert traders, they, they have a different way of making money from the same trade. Maybe the Apple is moving and they will not trade Apple. Maybe they will go and buy Baba, and then you will wonder why, what Baba has to do with Apple. So they will give you the reason that I saw Apple moving up and I went ahead and bought Baba. Or I saw Nvidia moving up and I went ahead and bought AMD. So that's their strategy. So think about your strategies. So now if you put that kind of when you create a Venn diagram for that market and trading system and trading strategy, your focus become more narrow. So your own trading strategy, maybe you just buy long calls and long puts, and your trading system you're using is fitting that kind of market. So now your focus is even more narrow. So think about this. Now the last thing is that what market you will trade. So you cannot trade 9,000. If you're trading a stock market, you cannot trade 9,000 markets, 9,000 symbols. So you have to do your homework and always be on the lookout for adding a new symbol in your trading universe. So you must have some way of adding a new symbol and deleting a symbol. So adding and deleting. So you're bringing some new candidates into this basket. So just think of it as a bucket, and you're adding a new symbol based on some criteria. So have some criteria of bringing new symbol. So I'm recently I started teaching my kids to play chess. So and you wonder, how smart they are to beat daddy. Daddy cannot win from their children hardly. So one day I was thinking, okay, the chess. How can I put this chess relate? So think about it. How can you relate the chess into the trading? How can you relate Bruce Lee into trading? So think about it. What was Bruce Lee? And if he was a trader, what kind of a trader he would have been? So I start thinking like that. Oh, if Bruce Lee was here, what if he was a trader? What kind of a trader he would have been? If a trading is a game, then chess, then what kind of players there would be? So I said, okay, I can divide the players into king, queen, knight, bishop, rooks, and pawns. So I do all that. And then airline, biotech, gold, and silver. So I have made all the list. So I give you just examples. So here, queen, kings, I call them king, queen, rooks, and bishops, etc. So kings are those stocks which are high price stock, like Booking.com and Broadcom, etc. They are high price, like $1,700, $3,000. I don't trade these. They are volatile and they have a wide spread. The option is very expensive, they're 3,000, 4,000. So I don't trade, but I watch them. Maybe I can trade a vertical spread, but I don't trade option because it requires a big portfolio. and one trade goes against me, let's say one option, then I am doomed. I don't have a flexibility in adding and exiting in these big movers. So, but they are in the list. They are more in this list. So I call them kings. Queens are the other ones. I will move on the other side. Kings are like Boeing, Caterpillar, so I call them just queens. Rooks are DIA, these symbols. Bishops are the small technology stocks, so all the stock. The big ones are the knights, I call them. So these are the ones which I trade frequently. So Apple, Airbnb, AMD, Amazon, Baba, Baidu, Coin, CRM, FSLR, Google, etc. So these are the ones which are trading, and I can read the charts better than others. So, and I can go as deep as the tick charts. So they have a certain rhythm. They move properly. So so I can read them. So I call them knights, and then there are other small stocks. I call them pawns. So I made this list. So I open. I say, okay, what the kings are doing, what the knights are doing. Even my team members know when I'm talking about knight, they know what I'm talking about. Or when so this is my way of doing my thing. And how I selected these symbols based on the market analysis, that I know these are the major players in the market. They are very liquid. So I know they have a liquid, they are volatile, they are always moving up and down. So for swing trading, you need the stock which moves up and down, not a dead one. A dead one is just dead. And then you can apply your technical analysis. You can read the fundamental analysis. You have option analysis, meaning the spread is narrow, is normal. There's a volume, there's a option, open interest is proper, there's a lot of activity going on. If you do the sector analysis, you can see if Apple is moving, or Meta is moving, and Nvidia is moving, AMD is moving. They always have some news. You can read the price pattern properly. There's a volume there, you can read the volume, and you figure it out, the risk and reward. So based on all this criteria, I created my baskets of stocks. So did that. Now, another important point is the time interval. So you need the time interval laid out on your trading system, on your trading platform. So there's a long-term time system, there's an intermediate, and then there's the short term. So I divide it into monthly, weekly, day, and 195 to divide the day into two bars. So there are 390 minutes. So in a day, so divided into two, so I get 2 bars of 195 minutes. So do that. You can have a 4-hour bar also. So you can have 4 hours. So you add 4 hour multiplied by 60. So what is it? 4 multiplied 240. So you may have a 240-minute time frame. Then, so these time frames are divisible into each. So think about it: 390 minutes divided by 13, you get certain equal bars. 78 minutes, 130, 195. Day has, and weekly has 5 days, so weekly time frame. For swing trading, you don't need to go into monthly time frame. It's too late. Even weekly is late. So, but I lean on it to see what is going on a weekly time frame. Everything starts on a day time frame because that's where the activity starts. That's where when the market open, it lands somewhere. So when the market starts, it lands somewhere. It lands on a day chart. It doesn't land on a 60-minute, I mean, it lands, but everything starts on a day. So ding, 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 the bell rings, 6:30 a.m. And suddenly the stock gaps up. It gaps up on a day chart. It doesn't gap up on, it gaps up on a 60 minutes. So you should see the lower time frame to see where it's compared to where it closed and what happened on a lower time frame. But see it clearly on a day chart, then flip the lower time frame. So I'll flip it and then I stock it on a 5-minute time frame, or maybe I stock it on a tick chart. So tick chart. So do all that. So when you combine all this, who you are, what kind of a market you can trade, uptrending, downtrending, what kind of a trading system you have, what trading strategies you have, and then on top of that, what symbols you can trade. So the laser, it become very laser focused. So you're laser focused, bringing everything together. So once you do that, then you are able to trade. So think about this. So there should be one more circle here, the trading universe. It should be not so you have all this, but the symbol you are analyzing it doesn't fit this criteria. It doesn't, like let's say AT&T. AT&T doesn't fit me. So it's like, no, get away, TNT. So it doesn't fit me. It doesn't fit my market. Doesn't matter what it's doing. It doesn't. It's just 20 cents up. I don't know what AT&T maybe moving up. I haven't seen it, but I'm just saying AT&T. No, no, no. So I cannot trade AT&T. So it doesn't fit me. So that symbol doesn't fit me. And if I find a new symbol, let's say I find a new symbol and it makes me money, and then I say, okay, I need to add this, and then it dies down. So that was just a few day of move, and after that, dead. So I say, okay, I don't need to trade that kind of a market with just so just get rid of it. I don't need to focus on it. So I just get rid of it. So I don't have time. I have already 250 symbols, 300 symbols to watch. So I rather focus on what I can read. Another thing, if you have a history of your trading and you're creating your trading journal, which is important. So you have all your close trades and you know the history. So if you put those symbols in the Excel worksheet and sort it, so something will come up in front of you, how many times you have traded that symbol, what is your performance on that symbol. So if you get that history and then you suddenly say, okay, AT&T is moving, and then you look at your performance and you say, AT&T, last time I traded AT&T was 5 years ago, and that's it. So you don't want to focus on AT&T, but if you look at Airbnb, you say, yeah, I had Airbnb 4 weeks ago, then 6 weeks ago, then 8 weeks ago. Airbnb is 5 times in 2 months. So think about it. Will you trade Airbnb or you trade AT&T? Now, another thing which I learned from my mentor, um, you want to trade the market which is actively moving and there is a participation. So the crowd, the wisdom of crowd. So the wisdom of crowd should be there. Yeah. So usually, if the stock is moving, there is a crowd behind, and the crowd could be the retail traders, but they are smart traders. So retail traders are also smart, but the big boys are already there, and the big boys are also participating, but the retail traders are also participating. So you're not alone in the market. You're detecting there is a move, and who could be moving the market. There could be institutional players, hedge funds, sovereign funds, pension funds, high frequency traders. They influence the size and influence. The program trading is going on. The buy program is they unleash the buy program. They just buy, and you on your system you would see 100 shares at a time. 100. So so everybody is buying 100 shares. I mean, 100 shares are, there is a reason for 100 shares, because one option controls, unless it's a non-standard option. So non-standard option could be one, because of the dividend and etc. Something happened. So there's a non-standard option. So non-standard option is controlling more than 100 shares. Maybe it's controlling 150 shares. So you have to make sure when you're trading option, you're trading the standard option, because um, if you do some strategy, maybe you will get 150 shares, or they will ask you to give 150 shares, and you thought one contract equals 100. So trade the standard option. So 100, maybe there is an activity going on in the option market, and the market maker or the specialist has to buy shares to cover that activity in the option trading. So that's why we see 100. It's easy to buy 100, 200, because the trading platform comes with it by default. So for instance, the trade session comes by default 100, 200, 500, and 1,000 shares. So if my system is telling me I need to buy 143 shares, I will round to 140 or 150, and I go buy odd lot. So I'm buying it, but the trader, they are just executing 100. So you see a lot of activities in a small lot size. Another thing you need to do is a price filter. So price filters, so make sure you're not trading something crazy low price. Volume filters, make sure the volume is there, make sure the stock is moving normal average true range. Make sure that, so you can watch how much the stock has moved during the first 5 minutes or 10 minutes or during the day. If it has moved certain price in X minutes, something is going on. If the stock has moved a certain level in price and volume, something is going on. So pay attention. You don't have to react, but pay attention. So if you react on a volume spike, chances are you will lose. So do that, and do all the price and volume alerts. So I have all kinds of alerts I get, intraday high, percentage up, percentage down. So I get all these kinds of alerts to see what else is going on, breaking the support, breaking the resistance. If the stock is trading above average volume, like Roku was doing, Shopify was doing, so I already knew it. Domino was doing. So all this kind of a system you need to have. Either you develop it, or you find a trading buddy who has the expertise to develop for you to do all that. Understand the volume. So pay attention to the volume trending. Is the volume trending up, or while you trending down? Whether this volume is a climax volume or a trending volume. So have some way of differentiating. Is it a climax volume? Is it a volume trending volume? What is the absolute volume doing? What is the relative volume doing? So pay attention to the volume, because if you only pay attention to the price and don't pay attention to the volume, you're only paying attention 50% of what you are supposed to pay attention. So you see how many things goes on in the market. And if you trade on just Robinhood, um, you don't, and you find your own trade based on the Robinhood and based on some Facebook or CNBC, you will lose. So these are the 12 trading systems, strategies, or techniques you can call. So I use all these 12. Not the black box. I wrote it black box because to explain to you what is there. You can buy a black box if it's there, or some indicators. I don't know, $49 indicator. So so I use all these, um, not the black, all from 2 to 12, depending on what is happening in the market. So what is happening in the market? So you can combine. So I'll give you some examples of, you need to combine 3, 4, 5 things and put together. Then only then you will be able to to trade properly. So I'll explain to you these. So black box is a black box. So think about it as a black box. The big boys have it. They have put all the mathematical model based on their analysis. So, but don't think the black box. If someone has a black box, meaning all the algorithm, etc., they are always winning. No, they are losing billions of dollars, billions and billions. They are going bankrupt. So don't think that the black box trading is the ultimate way. They lose money. They lose in billions because their mathematical models, they program it based on mathematical models. They forget something. They don't. They forget that there is something called black swan event. They forget about the human. The human will, even Isaac Newton. What kind of scientist he was, or who he was. Even he lost money. He traded one time. He traded in the market, and he got duped. So even Isaac Newton lost money. And the greed killed him. He invested the money in the South Sea, some company named South Sea. He invested money, and his gut feeling was telling him that he need to exit. He had a lot of profit. So it was a kind of Ponzi scheme. He invested it, and he was in making money, and he cashed out, locked the gains, and then the greed sets in, and he went back, and then this time he lost everything. So try to understand that these black box make money, but they also lose billions of dollars. So the black box, whatever the mathematical models is. So think about that. Black box trading is based on all the price, data, volume, and all the strategies they have. God knows what is beyond me. So they have done the back testing of all kinds of market. You can create, maybe you can create your own little black box. You program it, and your system is giving you entries and exits. So maybe you can do that. If you do that, then you are following the system, and it's flawless. One of my friend, he worked for Microsoft, so he has developed his own black box. So he finds entries and exits, short exit, and then he just goes do his work, consulting work, whatever he's doing, and then his system is running, and he's just making small money, and he has a very tight stop loss. So he does that. So robust risk management is needed in the black box. If you got the trade and you're leaving it to the black box, and black box is faulty, you can go bankrupt. So you can Google how many funds have gone bankrupt because their program was unable to handle, or there was a bug in the system. They thought everything is perfect and it wiped out their account. So be careful. So advantages of black box is consistency. So you see something and you execute. You tell the system, okay, buy. When you see this, buy 100 shares. Then when you see this, add another 100. When you see this, exit 50 shares. Then exit another 25 shares. All that. So there's no emotion, but it can go crazy. So there's an efficiency, there's a speed, and there's a scalability. So if you're reading the chart and you want to buy 100, so you can buy 1,000 shares. It's the same black box, same indicator. But if you're the only one, if your system is telling you based on your risk management, if your system is telling you you can buy 1,000 shares or 10,000 shares, and if you are the only one in that market buying 10,000 shares, then you're creating waves in the market. And then suddenly there will be something happen in the bid and ask, and then the market will notice you, and you may be left holding that 10,000 shares. So there has to be some limit of a certain float that you restrict your black box. Don't go beyond this. So think about that. Now the black box is dependent on the data. So if you have programmed it, then it relying on the data, and the data may be faulty. So what it's reading, open, high, low, or close, it may not be correct. Maybe there's a bad tick or something like that, and then it goes crazy. So think about that. The black box is as good as the availability and the quality of data. It's as good as the market condition you have programmed it. And if somebody else is using the same system you have, so if you have created a system where you say, okay, 30-day, based on the 30-day close, my system kicks in and I buy this many shares. if if, and I'm sitting in San Diego, and the guy in Fiji Island have the same system, so he's executing the same. And then another guy sitting in Hong Kong, he has the same system, so his program is triggering it. And I wake up in the morning and I say, oh, my black box. So black box buy my share. So you see, everybody is buying it, and the stock is start to shoots up, and then everything goes bad. So think about that. So another strategy or another trading system is a chart pattern. So chart patterns is what? It's a visual representation of historical price movement. So think about a 5-minute. Let's think about the 5-minute bar. So what is a 5-minute bar? So 5-minute bar, if you dissect the 5-minute bar, it has an open, low, high, and close. These are the 4 prices. And in between, there are thousands and thousands of transactions. All that thousands of transactions, 100 shares, 2,000 shares, 5,000 shares, bid, ask, this, that, odd lot, even lot, all that kind of transactions happen. So you can plot it. If you plot all those transactions on a chart, let's say, you will create a lot of dots, dot, like it's like a galaxy. So you're watching like galaxy, and then you say, okay, this is out of all those transactions, I see the lowest price is this, so you put that. And then the highest price is this, so you put that. And then open during this 5-minute interval is this, and the close is this. So you can, and then you say, okay, I'm going to put a right line on a bar, right, to denote this is the close. The left, I denote this is the open. No, I want to create a candle. So you say, okay, candle. So you go and draw the candle. So you draw the candle. Then you say, okay, I need to color it white for bullish. But another guy saying, no, I need to color it black for bullish. And another guy sitting in China, he said, no, I need to color the red for bullish. So you say, what? You say, yes, in my country, we color red. The first time I saw like on the news on Bloomberg, and it says Chinese market is up this percentage, and they see a bunch of red symbols. So I said, what they are talking about, the Chinese market is up. So figure it out, they denote red, all the up. So think about all this. I explained to you that's the way the 5-minute chart is looking on the screen. So visual representation of historical price movement. So, but you can gain valuable insights into future price trends. So you put 5-minute bar together. So you say, okay, I'm trading based on 15 minutes, so I need 3 5-minute bar. So you're looking at 3 5-minute bar. 3 5-minute bar, one is open, second is one was bullish, another one was bearish, the third one was bullish, or all three bullish. So you're reading all that, and then you're figuring it out. Okay, you're saying, one time my son came and he said, Daddy, I learned something to draw. I said, what? He said, okay, I'll draw something, and you tell me what I am drawing. I said, okay, go ahead. So he drew, like, literally he drew circles, like that. He even picked up a pen, like a color pencil, blue, and they, what is it? I said, it's dog. He said, no, it's a cat. So he said, next. So I said, okay, go ahead. Then he drew another one. He asked me, what is this? I said, it's a cat. No, it's a dog. So similarly, what is dog for you may be cat for me. The way, maybe something on the cloud, you're saying, no, 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 I see a hat. And then I'm saying, the other person is saying, no, it's a pillow. So same bars, and they're creating image, and we are coming up with different uh, meaning. And we are saying this is a head and shoulder, this is a double top, this is a double bottom, this is a triple top. um, so somebody saying, somebody sent me message, hey, it's creating a double top or double bottom. So I look at the double bottom and say, what, double bottom? Where is double bottom? So I'm looking at the day chart. He did not specify the time interval, and I'm looking at the double bottom, and I don't see double bottom on a day chart. So I shoot back and I say, hey, what time interval are you looking? Where is double bottom? And he said, it's on 30-minute chart. So I said, damn, a 30-minute chart. So you see, he did not qualify that. So in other words, um, we need to ask a proper question. So because the person is saying something in a different, he has this different anchor. He's anchoring it on a 30-minute. I'm assuming is a 30-day chart. He's saying double bottom. He is going long on a double bottom because he Googled and or he went on a YouTube and he said, oh, double bottom is the chart I need to master. So he goes master double bottom. So he's looking for double bottom. I see double bottom here. So he goes and make his entry on a double bottom on a 30-minute, whereas that double bottom was just a short-term pit stop. It was just reacting. The price was reacting at the 30-minute, and it was creating a double bottom, whereas on a day chart or on a 2-hour chart, this price was rolling down. So when you're reading the chart pattern, is all subjective. So make sure that you understand the chart pattern and discover the entry and exit price properly. So the common chart pattern I explained to you could be ascending and descending triangle, cup and handle, double top, multiple top, double bottom, triple bottom, multiple bottom, flags, head and shoulders, wedges, etc. So you can master all that, and it will take you your lifetime. Or you can focus on few things. So think about that. Through the chart pattern, you can detect the change in the trend. So based on certain chart pattern, you can detect the change is happening, and you identifying that trend. But identifying the trend is one thing, but confirming the strength of that. So on what time frame maybe. So the chart pattern double bottom appearing on a 30-minute chart may not be as powerful as appearing on a day chart. So think about that. Double bottom appearing on a day chart and there's no volume is not as proper if the volume is there. So that's another one. Double bottom on a day chart and the volume is there, but the support is not. So you say, okay, I go long on a double bottom, volume is high, day chart is there, but you look at the support, you say, okay, if I lose, where I will lose? Where is the like basement? So if you are entering at the first floor, and then you say, okay, where is the basement? Does we have a basement? And you say, yeah, basement is there, but the support is at B4 level, not in B1, B2, B3, is very, very far. So if you're going to lose, you will lose big. So pay attention to all that, and then you figure it out your targets and your stop loss price. So your chart pattern skill is as good as your, subjective. So you can get trapped in a false signals. It's highly subjective. What is dog for me is cat for you. So beauty lies in the eyes of beholder. So there are a lot of market noise. So you have to properly read the chart pattern. Now, another strategy is the band trading strategy. So band trading is embracing volatility. So capitalizing on a short-term price movement. So you say, okay, I trade this is stock, whether it's so it's good for sideway market maybe. So sideway market, you say, okay, this market is sideway. I'm a sideway kind of guy. So I go long when the stock hits the lower price level, and I go close it when it hits the higher price range. So maybe you can do that. So if that's your thing, you can identify the price ranges, and you're just trading long, short, getting. Sometimes the traders, they always have a position either long or short in the same symbol. They either have a long or short. They are always in the market in that symbol, whether they are long or short. That's the trading system they have. So if you can develop that kind of trading system, once you close the long position, the system automatically reverse. So on your trading platform, you may even see a button or something to reverse the position. So you close, you have 100 shares. When you close the 100 shares, um, you buying 100, you're shorting 100. So you're closing your long and you're shorting 100 at the same time. So if you can do that, maybe it's good. You're always in the market, whether long or short. So you can write, you can create a 20-day moving average, a simple exponential, and you can create the upper band, lower band. So do the research on the Bollinger Band, etc., and buy and sell at the lower level and higher level. Sometimes the price break the lower level, then it's another signal. Price break the upper level, then it's another breakout. You can combine the band with some indicators, some moving averages. So for me, is very dull, and I don't do this. So Bollinger Band setting based on a standard deviation, Donchian channel, Kettler channel. So there are different strategies you can master. So think about this. Does it fit you? Maybe it doesn't fit you. So you can identify the overbought and oversold conditions. So overbought, it goes on the higher level. Oversold, it goes at the lower level. So band act as a dynamic support and resistance level. So think about this. There's a static support and resistance, which is based on the historical price movement. So it's like a graveyard where all the traders are buried. Some traders are buried, some are well and alive. So we don't know who got killed at that price level. But the battle was fought. So that's why there is a support and resistance. So, but that because it happened in the past, so it's a historical. So it's historical there, but that historical price range will come to play when that same price, when the market reaches the same price again, especially if it happened recently. So the more recently it happened, the more it's like that the buried people, they got recently buried and they get alive. So there's a lot of action comes if it happened recently. So the longer, so I tell you about the Apple had a resistance at 193, 194. So it created a lot of resistance 193, 94, but it happened like maybe 6 months ago. So for Apple, that resistance at 193, 194, which happened 6 months ago, may not be valid now. So the maybe for me, I think it will react a little bit, but it will conquer, and the next one will be 200. So, but if you're applying, you say, okay, no, that is a static support or resistance at 193, 194. I will use the band to figure it out, the dynamic support. So as the market is building, you're figuring it out, the dynamic support and resistance, and you're capturing the breakouts. Once you know the dynamic support and resistance, then when the breakout is happening for that support and resistance, you're capturing that price movement. So people have the system, they go for the breakout when the market breaks the upper level of the band, and the other indicators lined up, they go long. And then they set their stop loss below the below left price, the lower band. So, but there's a limitation. So everything has a limitation and has a advantage. So think about what are the limitations and what are the advantages. So false breakout can happen below and above band. So volatile market, whipsaw can occur. It can go like this, up and down, and then you are just getting chopped. So adjust your, and then you should be able to change your, adapt to the market condition, adjust the band parameters to suit the changing market conditions. So what adjustment you will make, you know better. So if band trading is your thing and you are expert in band trading, then maybe you just do the band trading and adjust the market condition. Now, another one, which is I trade, so I don't trade band, I trade trend. So trend trading strategy, whether the trend is in motion, um, or the new trend is building. So what is trend trading? So riding the market momentum. So riding the market momentum, especially the trend trading works best when the market. So think about this. You have to ask, okay, for market is in uptrending and it's quiet. So when market is uptrending and quiet, then you say, okay, market is uptrending and quiet. What kind of trading system I should use? So trend trading, because there is a trend and the market has a sustained price movement. So you have a low margin of error and you're trading in the direction of the prevailing trend to stack the odds in your favor. You're using certain technical indicator to support the trend. So or maybe to ride the trend. You have the ability to detect the change in the trend. So entering the trade early. So do you have a system where you can detect the change in the trend through the help of candlestick, through the help of some other trading system? You're detecting the change in the trend. Maybe you're applying the volume analysis and figuring it out the changes is about to happen in the trend and I need to close my trade or I need to put this trade in my watch list. So all that is going on. You can use the help of a moving average. So think about it. You can use you can take help of a moving averages such as 10-day moving average, 20-day moving average. So the trade is already in the stock is already in uptrend. So now where to enter? Maybe you take some help from the moving average. Maybe you draw some trend line. Maybe you use some Fibonacci trend line. Maybe you use parabolic SAR. So you have identified the trade is trending. Now, what would be your method of entering and exit? So think about that. Identify uptrend and downtrend. So moving averages and trend lines. You can plot the trend line. You can use help of a 10-day, let's say 10-day exponential moving average. You can add, based on these moving average, you can enter into entries and exits. So trend line breach or moving average crossover. So if the moving average is crossing 10 or 8 exponential moving average crossing over 11 exponential moving average, then your entry. When the 8 crosses below the, let's say 20-day moving average to the below, then you say, okay, that's my exit. Or you can put some trailing stops to protect the profit and stay in the trend. So, and the trailing stop, whether this trailing stop work for the option, maybe not. Maybe the trailing stops only work for stock. So you have to ask this question: the trailing stop work for option, and what kind of option, and what kind of a market? Maybe the trailing stop will work for Tesla, but it will not work for stock like small price, $30 to $40 stock. Trailing stop may not work. You will give back all your profit. So limitations, so false signals. Maybe you're thinking this is a trending market, but it was a choppy market. Suddenly, the trend has changed and it becomes a choppy. So whipsawing occurring. You're exiting sharp reversal, and your exits is not correct. So you have to take help from the chart pattern, the candlestick, the indicators, the volume. So the trend is there. You can read the trend, but now you need to take some more help. So ask questions for any system. So for any system, you have to ask these some questions. So do you believe in trends? So or do you believe in band trading? Do you believe in the system? So ask yourself, do you believe in it? Does it fit your style? What strategy you will adopt? So you believe in trend trading, let's say it fits your style, but then what kind of a strategy will you use? Will you buy shares? Will you buy options? Will you buy vertical trade, you'll sell puts. What would you do? What would be your scaling in? What would be your scale out strategy? So what you will do once you enter, once you identify that trade, what would you do with it? Where would you put the stop? How would you take the profit? How you understand the targets? So some stock they're moving. So let's say Domino. Domino is the stock. To it's easy to read the charts and figure out the the targets if the trade has traded before. So it's trading in a previously travel. So like just like any does, if you have traveled from San Diego to Santa Barbara many times, you know the road. But if you go beyond and you go on the right side or left side you go in the ocean, you go right side, then you suddenly you see the mountain, etc. So you've never been there. Now you are confused. So yesterday, I'll tell you, I don't know, it happened after a long time. So not yesterday, Saturday. So Saturday evening, I took the road. So I was coming back from Big Sur, and I took this road, 46, something like 46 East. So I cut this in, I saw on the GPS, I said, okay, I take this road and a scenic route. So I was over speeding. And usually, this is I know my problem. I don't overspeed when I'm traveling here, where I live. Doesn't matter, LA or San Diego, wherever I go, I just go in the normal fashion. But when I travel and I take the scenic route, and somebody somewhere is sitting on the corner, in a scenic route. And this was a scenic route. There's nobody there on the road. Like you can see the mountain, and there's nobody there. And I'm driving, and I know on this scenic road. Then I turn on the music, and I go on to play my favorite song, and that's where I go above the limit. And that's where the cop is sitting there. And he came. So he turned on his light. Before I even read, he turned on. I said, "Oh my goodness, again!" And my son said, "Daddy." So I immediately stopped the car and roll down my. So I see him coming, and I know he will come on the right side. So by the time he came, I had my driver license and everything ready to go. As soon as he dropped, he came, I pulled the window and I gave him everything. Okay, here's the insurance, here's my driver license, here's my registration. And I'm sorry, officer. I know I was driving over speed. I don't do this, but I got carried away. So he asked me this. He said, "Where are you going?" I said, "I'm going home." He said, "Are you sure you're taking your GPS is telling you this?" I said, "No, I'm not sure, but I took this road. It looks like scenic road. So I took this road. So am I going wrong?" He said, "I don't know you're going wrong or not, but you are going over speed. So do you know that?" So I said, "Yes, sir, I know that." He said, "Okay, I'll let you go. Be careful next time." So it happened after a long time. So thank you. And then my son is asking, "Daddy, ask him why he's not giving you the ticket." I said, "No, no, 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 no. I'm not going to ask him why he's not giving me the ticket." So 5 miles away was I-5 South, and that's it. So what would be, so I just got distracted. So what would be your profit taking strategy? What would be your position sizing strategy, meaning how much you will be investing? Once you exit from the trade, let's say you exit from the trade, how you will get back in the trade? So sometimes the trade keeps moving like a split line. So a split line is going up and up, and it's going into an higher level, 15, 16, 17. So how would you get back in if you're not in the trade? So how would you read the chart where it has not traveled before? So how would you read that? So like Domino Pizza, if it's breaking a new level, how would you, do you have a method of measuring the new target, uncharted territory? So do you like this police officer? He asked, do you have a GPS?" I said, "Yes, I have." He said, "What the GPS is saying on the speed limit?" I said, "Sir, I sorry, I didn't notice." He said, "It is saying 55 miles per hour." So and he was right, 55 miles an hour, and I was going way beyond. Like I was going way beyond 50 miles, as if I am somewhere in Arizona or maybe beyond. Like I was somewhere in the space. So that was not good. So think about this. Once I exit from the trade, how will I get back if the trend resume? How you will get back? What will be your scaling in strategy? How you will pile up on that trade, and how you will start to pile exit. So think about this. What will tell you that it's time to exit from the trade? Maybe that trade is the one trade which is tilting the balance. So you have a profit in overall portfolio, but if you look at one trade is the major part of it. So if that trade is the major part, that is not good. It's good, but you have to be very careful, because if that trade goes against you, first of all, you're running out of buying power. Maybe you're overexposed, and then if that trade goes against you, then it will be morally demoralizing. So think about, keep that in mind, scaling in and scaling out. Maybe the trade is being volatile now. So you enter in the trade and it suddenly it creates a volatility and it's accelerating. It's accelerating, the volume is increasing and the news is coming. Maybe it's the time for you to exit, not enter in that trade. So think about all that. Another system you can develop and you should have is a support and resistance, which is a key price level where the market reverses stalls. All the psychological buyers, all the market participants, all the psychology understand that. We are running out of time. So understand all this. This is a big topic. So, but pay attention to the support and resistance and learn to identify support and resistance, because that's your entry and exit. So support level, buying interest is strong enough. Resistance level, selling pressure high. Collective actions of market participants. So understand who are the participants, who, what kind of a psychological uh, barriers they are bringing in. What thought process is going on. So understand that. Pay attention to the swing highs and lows. Pay attention to the psychological levels like 100, 200, 500, 1,000, 250. That's what I paid attention today in Shopify. Moving averages, 20-day, 50-day, 20, 200-day moving average. So pay attention to these moving averages. So based on support and resistance, you can identify the entry and exit points, set a stop loss level. You can gauge the market sentiment. I have this chart, which I go into detail. I will explain some other time. So this is the way the market, uptrending market goes. It creates resistance, then it creates support, then it creates resistance, then it creates support, then it goes into uncharted territory. Let's say domino is going high at 400 level. So let's say the domino is here. You don't know where it's going. But in the trending market, this is the way your entries and exits looks like. In a downtrending market, and there's a lot of thing goes on behind. In a downtrending market, this is the way the downtrending market looks like. So it creates a resistance support, then resistance support, but the resistance are being created at a lower level. You see the resistance level is created at the lower level, and this if the market is downtrending, the resistance are being created at the lower level. If it's an uptrending market, the supports are being created at the higher level. So that's the definition of a uptrending market. And this is the definition of a downtrending market. So resistance is being created at the lower level. So you have, if you are focusing only at this level and where the new resistance level is created, you are in trouble. So understand the new resistance level as the market is moving up and down, and understand the new support and support level also as the market is moving up and down. So pay attention to that. And limitation, it can be false breakdown below support. So you think the support is broken and you go short and the market goes up. You think the support resistance is broken and it comes down, so it's a false breakout. So all that happening, you have to pay attention to multiple time frame also, not just day chart and not only the intraday chart. So if you're looking at the double bottom on a 30-minute chart and think, okay, this is the support, maybe that's a temporary support. So pay attention to all time frame. Now there's another strategy of a breakout strategy. So breakout, I also trade breakouts. So breakout is the price breaking certain level, either the support or resistance. So something is happening at the key price level. So think about that. Something is happening. Either it's breaking it or reacting it and reversing, whether reversing from downside to the upside or from upside to the downside. Something is happening at particular price level and it's happening sharply with some volume, some sharp things, some phenomena is happening. So that is a breakout. So type of breakout, so breakout above resistance. So you figure it out, there's a big resistance and it's breaking the resistance, so it's a continuation of a bullish trend. If it's breaking below the support, it's a continuation of a bearish trend. Maybe you have a strategy of a retest of a breakout. So you identify the resistance support, it broke, but now you're waiting for it for a retest. Once the retest happen, it hits the support, and now it's falling back down or moving up. That's the support. So maybe you say, okay, 30-minute has given me the double bottom, and now I want confirmation. So you wait for, so from some kind of a pullback to that 30-minute time frame or the level, and then when it's bouncing up, then you know that, okay, that 30-minute was my entry level, and it was early signal. So I'm not saying the 30-minute is not. 30-minute can be perfect entry, and it could be early entry, but you have to know what you're doing. So trend reversals, capture bullish trend reversal, opportunities for profit, confirm breakouts, use volume and other indicators. So breakout is just, there's no, if it's just a breakout and then it dies down. So have some volume should be there, and you should have some method of calculating the price target. So if Domino is breaking certain key resistance level, let's say at 389, then if it breaks 389, where it will go next? What do you expect? So do you have a method of calculating a new target, uncharted territory? So do you have a GPS where you know where you're going? If you dissect this, from 101, you will take this diagonal road and you will hit I-5. So you know I-5 will come after 20 miles, and in between there will be, so just like in trading, in between there will be a police officer, and they will stop you if you don't follow your proper, and you may have to take a detour. So like a detour happened. I took this road, Pacific Coast, one north, and I entered it. So I was going towards Big Sur. So I entered it near Hearst Castle, and suddenly I see a sign, the road is closed after 20 miles. There's no detour, so reverse. So that can happen. So that exactly happened to the trade. The trade reverses and it goes the other way, pulls back. Um, some time is taken, and eventually it goes and you reach the destination. So eventually I reached my destination, but I lost like 1 hour or so. So Domino may hit 400, but instead of in 3 days, it may go in 7 days. But you know where it is going. So think about that. Limitation and risk management. False breakouts, false signals can happen. Whipsaw can happen. So if you're trading a volatile stock like Domino or Tesla, etc., pay attention. You don't want to overtrade. Now, if you reverse the breakout, then it's a breakdown. So reverse of breakout is a breakdown. So I call it breakdown to like people call it breakout, whether it's a breakout to the upside or breakout to the downside. But for me, I say, okay, breakdown. So it's breaking down, breakout, going up. So breakdown. So breakdown of support. So the support is broken. So I call it breakdown. So it resonates with me. So you say, why you call it, like when somebody say breakout. So I tend to look at breakout as if the stock is or the market is moving up, but they are calling breakout when the market is also calling it when the market is moving down. So I divided breakout and breakdown. So prices break key support levels. So you're capitalizing on a bearish trend. So some kind of bearish trend. So breaking down below support. So you're expecting a bearish continuation. Breakdown retest, have some kind of a retest, and also use some kind of a momentum indicators for the breakdown. So some volume is accelerating unless it's a volume climax where it's, you are the last one to go short in it. So then you will see the reversal. So I think Baba is doing it. So we'll see Baba. I expect Baba to move up. So application in trend reversal. So capture bearish reversal, set price target, and manage risk. So anywhere you have to manage the risk. Limitation. So fast breakdown. If you think the support is being broken and next day it moves up, usually that's what happened. The support is broken one day, and the next day the beauty lies in the eyes of the beholder. The other guy, they're thinking it's a fair value and they should be buying it. The chances are that the chances for your success is if you read the breakout to the upside and you go long, your chances of success is higher Then when you're reading the breakdown and you go short, and somebody thinks, because there's a deep pocket, they think that is oversold, or they think this is a fair value, and you say what, and then they go buy because they have other, they are a long-term trader and you are a short-term trader. So they are long-term trader, they can hold. They are like Warren Buffett, they can, Ray Dalio, they're buying it in millions and they're holding it way below like $11. And then you say, oh, $11, what they are thinking, it's going to $6. No, it's not going to $6. It's going, 1 year later, it's going to 22. And you went short on a breakdown. And you went short on $11 and it went down like $10.50. And then below 10.50, it didn't go below, not even 10.49. It went to 12. Then it went to 20. So make sure the breakdown, you're trading in a bearish market and then properly reading it. So breakdowns are hard. Now there's another hard trading is a gap trading. So you see, you need to combine the gap with the trend, with the support and resistance. So gap trading is what? So gap trading, whether to the upside or to the downside, is exploiting the price gap. So you're exploiting the price gaps. So the price closed at 100 yesterday, and today it opened at 110. So there is $100.10. So there is a 10-cent gap. So that is a gap, but that is not a meaningful gap. For the gap to, you need to define your meaningful gap. What is considered as a gap for you? Meaningful gap. So think about that. Market can open higher or lower. So the gap produce unique trading opportunities, and how quickly you react. So how quick you react to like tennis. So if you play, so think about this, you're playing chess. My son played when he's 5 and he started playing chess, and he act like as if he's a tennis player. I said, hey son, you don't have to move so fast. And if I'm thinking, he said, Daddy, you're taking too long. You need to move. So think about this. Gap trading is like tennis trading. And so suddenly the stock opens, and then you have to put 2 plus 2 together and say, okay, I really need to decide which way I need to go. Should I leave it or should I go? Where is my pullback? What is strategy I need to adopt? You cannot just, you can think forever. Maybe you say, okay, gap happened, and now I will wait for the gap to fill. So you become a chess player. So think about that. Are you a chess player or you're a tennis player? Who you are when you're trading gap. So gap up trading, gap down trading, gap reversal trading. So different is trading. So and then what market is doing? Is the market bullish? So if the market is bullish and the stock is gapping up, most likely you should go long because the market is in your favor. So gap up. If the market is bearish and its market is gapping down, maybe you should go in the direction of a gap down. Now, if the stock gaps up and the market is bullish and you try to short that market, gap reversal, maybe you will get killed because the market is bullish, the stock is bullish, it gapped up. So you have to believe that the stock gapped up in a bullish market and there is a news, the chances are that it will continue to go up. Then to reverse. So think about it. Why are you going down short on a bullish market when the stock is gapping up on some news? You don't have to trade that. If you don't believe in that, yeah, just don't trade it, but don't reverse your trade. Don't go short. However, if the stock is gapping down and the market is bullish, then the signal should ring. Okay, this is stock. The market is bullish. There's a stock gap down. Um, and let's see if I can identify my entries. So you notice that you become a chess player. Then you don't have to be a tennis player that you go immediately you go long. You can start identifying your lows and highs and highs and lows and highs and lows, and then you time your entry. So you become a chess player. So you don't have to be a tennis player. You have to you have to reverse the fall. So think about that. So what is gap? So price discontinuity, quick profits, market sentiment. You have to pay attention to market sentiment because the gap and up or down is telling you there's a sentiment change in sentiment. So there's a change in sentiment, and you have to understand there's a change in sentiment. And if you're trading gap, the gap can reverse, the stock can reverse, pull back, and it's just a pullback. And if you don't set your stop loss, you're out. So you said, oh no, I traded gap, and then it took. They are out there to get me, as if you're the only one with your 100 shares, and they are out there to get you. They are gunning me, They, these guys, they are gunning for the stop. They came and got my 100 shares, and they rode it away. So no, they don't care about your 100 shares. It's just so happened you put the stop loss at a very ridiculous level, and that's what happened. So it's just a natural phenomenon. The stock pulls back. It was at support. You put it there, and then they came. They saw this is a fair value, and they are doing their business. They are not buying 100 shares to come. They're waiting all day long. Okay, let's see where Albert puts the stock right there. That's where we need to go, and they go, and then they get your 100 shares. No, it's not like that. So think about that. So they are not out there to get your stop, 100 shares, unless you have 100,000 shares and they are going for millions of shares. So maybe that. So limitation and risk management, window open, window close. So the gap open and gap close. So think about that, window open, window close, window open, window shut, window open, window shut. So it can happen. Not all the gaps can be closed. So some gaps are open. So there, I was looking at one chart today, and I saw there were two gaps already occurred in that stock. And it's, son of a gun, two gaps already. So there will be a third gap, and then when the third gap, maybe that will be an exhaustion gap, and then the stock just pulls back. So gap is an overnight risk. So the stock gaps up and gaps down. So you have to, for the gap trading, you have to understand the support and resistance. You have to flip your lower level chart frame. You have to apply the opening range breakout strategies, where you time your lows and highs on a based on the time interval. And if it makes a new high on a 30-minute time frame, then you say, okay, 30 minutes gone by and it's making a new high. This gap is making sense. And 30 minutes gone by, and it's trading within that time frame. It's not moving up, not moving down. It's just there. So if it's moving up and down, then it's creating an opening range. So it's called opening range. So gap reversal is a specialized technique. So be careful with the when you are doing the gap reversal. So it's a reversal of initial price, and you can focus on capturing price movement. So gap up, and you define your risk. Suddenly you say, okay, this is the high, and here is my risk, and now I'm entering it. If it goes above, I will be out, but I'm expecting it that it will reverse. So I did it in a Microsoft. Microsoft gapped up. We were long, so we closed it. And the same day we opened a put position, and the next day we closed that put position because it was a gap reversal trade. So gap reversal trading, selling short, gap down reversal, going long, and gap fill. So gap fill trading is where the market gaps up, and now you're figuring it out, where is the support, whether the support is at the open of the gap or the close of yesterday gap, so yesterday price. So if the stock gaps up from 100 to 105, and then it's trading at 110, so it's the support at 105, which is the open, or the support is at 100, which was the yesterday's close, or the support is at 102 and 50. So you have to understand where is the support, so you can time your entries, or maybe scale in more when the stock pulls back. But if you set your stop loss just below 105, so if the stock gaps up at 105 and it's trading at 108, and you went long, and you say, okay, it opened at 105, and I will set my stop at 104 and 50, and then it goes to 104.50, it goes to 104, and then it goes 106, 108, 110, and then you say, son of a gun, they are out there to get me. They got my shares. So pay attention. Um, the gap can be filled, and gap may not get filled. So application in identifying trend changes. So capture trend reversal via gaps. So think about that. Confirm your signals of the gap via volume and some indicators, because if the gap occurred and there's no volume, that's it. If you are done, you will be the only one buying it at the end. The music has stopped, and you don't have any chair. So set price targets, measure the height of the gap. So how you would come up with the target, have some way of calculating the target. False reversal can happen. in the gap also, the market gaps up and then sharp reversal, market gap down and then the sharp reversal. So there's a volatility. So timely execution, you have to act quickly. So it's like sometime in the gap, early morning, you have to be a tennis player, not the chess player. It may not work. So you can do like this. I'm just thinking right now. I never thought about tennis and chess. So think about this. So if the market gaps up, and you say, okay, market gaps up, and I need to get in because this market is looking really good. So if your system is telling you you need to buy 500 shares, you don't need to buy 500 shares. You just buy 100 shares. So you became a tennis player. You just said, okay, 100 shares, right there. Now you are in the trade. You are emotionally involved in the trade, unless you do some boo-boo. So your 500 shares, instead of 500, you did 100 shares loss. So you will lose on 100. So it's okay. Now, after buying 100 shares, then you become a chess player, and then you sit properly and you say, okay, now I need to add another 100. Either it's pulling back at this price level, I will add another 100. Otherwise, it's fine. It just keep going, and then you miss out on the other 400 shares profit. But at least you have 100 shares and you lock the gain at 100 shares. But if you became a chess player and you say, no, I will time my entry and I will get in I will get in with 500 shares, and you may not get the entry. So when the breakout is happening, when the gap is occurring, if you think it's looking really good and you're getting a good feeling in your tummy, go for it for at least 50 shares, 75 shares, 100 shares, whatever is, just one half or one third of your, uh, money. Now the last one, the second last, is intraday reversal. So intraday reversals happen, meaning the stock is coming down, coming down, and then suddenly it starts to move up. Maybe the market, there was the FOMC minutes and everything was looking good, and somebody spoke, FOMC, and then the market suddenly started a reverse, and then everything is going down, and then they say, oh no, he meant this. Okay, so everything is starting to move up. So if you have a watch list, or if you're already in the trade and you see the intraday reversal happen, so if you're already in the trade and the intraday reversal happening, and if you have the buying power, maybe you add a little bit, another 100 shares, maybe another contract. So think about that. So you have to act quickly. So intraday reversal is like tennis playing. So you have to really be on a lookout. So key reversals, making new high or low, but closing in the opposite direction. You may adopt the pivot points. You can have a pivot point on your chart, such as high, low, close, divide by 3, or high, low, close, open, divide by 4. Whatever is your thing to create a pivot point, because the traders are using the pivot point. They have complex formulas, but the simple one is, if you Google pivot point, you will find 3, 4 formulas, and then you can plot on your chart and use it as a support and resistance level. You may use candlestick patterns such as doji, engulfing, and others, and you can use combination. So you see, you're using intraday reversal, maybe gap up. You're using support and resistance. You're using pivot point. Maybe using volume. You're using candlestick pattern. You're putting 2 plus 2 to make it 5. So application is short-term trading. Capture short-term profit, manage risk, and confirm the signal strength. So you need to have some way of validating your entry. So have some secondary evidence. So it's like, you CSI. You get this, whether the dog is barking or dog is not barking. If the dog is also barking, so maybe I have a correct, I'm reading it correctly. So the volume is there, indicator is there. So I am going long or I'm going short. So it could be a false intraday reversal signals. So don't. So there is a catch in intraday reversal. If you The longer you wait, the more risk you have, because the longer you wait, the price is getting away, and your stop loss is somewhere below if you're going long. So the quicker you act, the less risk you have per unit and the more profit you have. So there's a trade-off. If you act quickly, maybe you did not read correctly, and then you lost. So in intraday reversal, maybe you initiate a little position, and then the market will tell you. Because if the intraday reversal is happening, the market will go if you're right, it's not intraday reversal just for one day, because intraday reversal is happening. It will move tomorrow and it will move next day. So what the stock is doing, if you look at Crocs is doing it, and I look at people. I mean, I'm not a Crocs person, but I see people wearing Crocs, and then they wear socks, and they are wearing a funny colors. And that's the trend. So the Crocs last week or 10 days ago, it came on an intraday reversal. So intraday reversal, and I caught it and I sent the email for the trade, and it just kept going and going and going. So every other day it was just going. So just keep adding. And now today also it's breakout. So the Crocs is, once the intraday reversal happens, something happened and they come in, and then it just move again and again and again and again. So if you can catch the intraday reversal, you get in a little bit, and the market will tell you whether you're right or wrong. You initiate a position, and then the confirmation will come. If the confirmation come, you pile up on that one. The last one is the moving average breakout. The moving average is, so there is a support and resistance. I told you the static. The moving average is dynamic. So dynamic support and resistance. So you use the moving average breakout, 20-day crossing above 50-day, 50-day crossing above 200, or 10-day exponential crossing over 50-day exponential. So whatever is your thing. So the weighted moving average, the adaptive moving average, the exponential moving average, simple moving average. So there are many moving averages you can plot and take help from the moving averages, moving average crossover, moving average bounds. So what kind of system you have? If you are using a trend trading system, then you're looking for some entry for based on the moving average bounds. If you are reversal, then maybe moving average crossover. So you can use moving average envelope. So different different traders, different strategy, different market, different moving averages. So it's capturing the trend continuation based on the moving average, identifying the trend reversal based on the moving average, setting the price target based on the moving average. So moving average, you can use moving averages for different things. Now the limitation, if you think the 10-day moving average is acting as a support, so think about it, 10-day exponential. Who says that the market must stop at 10-day moving average? Because that's your, you think so. You believe that the 10-day moving average is the ultimate support. So think about it, moving average is what? It's just adding the last 10-day price divided by 10. If it's an exponential moving average, then the recent day is taken and the last day is dropped, and you can come up with the formula. You can give more weight to the recent day, and then you say, okay, I see this is it must stop there because I said so. And the market said nope. Suddenly somebody comes and sells 10,000 shares, and then it breaks the moving average. It goes down, and then you are out. And then next day it goes back above the moving average. So think about moving average. Use some volume, some other criteria, some secondary evidence. So think about the moving average and trade like Bruce Lee. So at the end, Bruce Lee, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So all this is good, but use one by one. Try to learn one, master it, go for next one, then use it, go for the third one. Then then you say, okay, I need to use 2 plus 2. This one is this plus this. But if you're trying to learn everything, you cannot learn. If you don't know what to put together, you will fail. So all this, but I explained to you, and maybe some there are more other things. So you put and utilize it in combination. So in combination. So be consistent in your trading strategy, be disciplined, believe in abundance or believe in abundance. There's always there. Continuously learn, develop adaptation, develop patience, implement robust risk management, learn from your mistakes, and have a positive growth mindset. And think about if the Bruce Lee was trader, what kind of a trader he would have been. And the last is that try to teach, learn and teach and give. So leave every person you come in contact with the impression of increase. So I hope today you learn something. So this quote is taken from the book called The Science of Getting Rich by Wallace Wattle. It's out there, PDF. You can get it or go on YouTube. 2-hour video, listen to it, and maybe you will get some insight. And last, another one by Wallace Wattles, you get rich by doing things in a certain way. So think about it, you get rich by doing things in a certain way. So all these rich people, they're doing things in a certain way. That's why they are rich. They're super rich. Why? Because they do certain things in a certain way. As long as it's moral, correct, you're not doing some hanky panky. You do the get rich by doing things in a certain way. So what is a certain way? So read this book by Wallace Wattles and Bruce Lee versus wannabe. So this is another slide. Mastery through practice, adaptability and innovation, emotional mastery. So think about Bruce Lee, mindsets and beliefs, continuous learning, risk management, patience and timing. Think about Bruce Lee and adapt or perish. So that's the end of today's session. And I talked for about 2 hours and 20 minutes. So thank you. And I will see you sometime. Thank you. Bye.